Welcome to Zoom Out with TouTzuSays. It's December 31st, 2023, and this is my 2024 outlook. But before we get started, here is a disclaimer. Please remember this is for your entertainment only. I'm biased, I have blind spots, and please don't take this as investment advice. Now, before we get started, let's take a look back at 2023. Here's a great chart that kind of shows you that last year, 2023, the stock market was pretty abnormal. We had a magnificent 7 stocks, the big tech stocks like Microsoft, Apple, Nvidia. They carried the whole market. What's also interesting, if we look at the market over the last 2 years, what we actually see is we've just made a round trip. We haven't actually exceeded much from where we started in 2021. I think this is very relevant to know. It feels like this 2023 was a gangbuster year. It was really just 7 stocks. And then if you had ridden from the beginning of 2021 till now, you would not actually be up by much, if at all. I also remember at the beginning of 2023, the outlook was not very good for this year's stock market. The big Wall Street firms all had trouble, and most of them missed most of this exciting ride. We had a banking crisis, we had the AI boom, we had a war in Israel against Hamas. A lot of interesting factors happened. Suffice it to say, the prediction game is very, very difficult. Having said that, this doesn't stop any of us from taking out our crystal balls and making predictions. So here's a list of some of the top Wall Street firms' predictions for 2024. At the bottom is JP Morgan. They are very good, very accurate. They're the largest banking institution on the planet. They are not looking very favorably at 2024. On the other extreme, we have Yardini, who is an independent investor. He does great predictions as well. He thinks it's going to rip-roaring year. He predicts the S&P ending at 5,200. So here we go. I'm throwing my hat in the arena. These are my 8 big predictions for 2024. My first crystal ball is I believe the US economy is heading into stagflation. That or a very, very hard landing in 2024. So let me explain this. I had originally kind of forecasted a shallow recession, but I've changed my mind. And when we go through this, let me explain why. GDP is broken down into 4 components. The first is the largest is the consumer spending component. We also have corporate spending and government spending, as well as net trade. So when I look at consumer spending in particular, that is the highest rate weighting in our economy in the US, consumer spending is driven by wages, it's by accumulated wealth, and by debt. And when I look at each of those components, I see slowdown, but I don't see something negative. Similarly, with corporate spending, our big corporate institutions in the US, the balance sheets are actually quite strong. Of course, you have the smaller, weaker companies who are going to face some issues, but the big boys, they're actually quite solid and stable. Are they going to grow a lot in 2024? I don't suspect they will. Are they going to spend a lot, expand their facilities? Also, I don't think that will happen. So I think it's going to be kind of a sideways thing, but not a negative growth factor. We have government spending. Yes, the Biden administration is not able to push through new fiscal stimulus, but the legacy policy fiscal stimulus that we had at the beginning of the Biden administration, they're still running. They're still carrying forward. There's still money being supporting industries in his policy directives, specific towards electrification, towards semiconductors, reshoring a lot of American tech. And blocking China from participating in a lot of this technology development. Finally, we have the net exports. And when I look at net exports for the US, the world is still needing a lot of energy, especially after the Ukraine war started. Europe was in dire straits and they needed more energy. The US stepped up and has been exporting substantial amounts of oil and natural gas to support Europe through their troubling times. When I take all of these factors in together, net, I still don't see GDP going negative. although I definitely don't think it's going to be very robust. This slide is a little bit economic wonky stuff, but when we look exactly at the different components that make up how they decide if there's a recession, you can see that based off the 2021, January 2021 level, all of the main economic indicators are still above water. And like I said, I do think that they're going to go sideways and even come down, but will they go below 2021 levels? I don't expect that to happen. Digging a little bit deeper into the consumer spending component, I'd like to share this chart. This one is basically saying that through all the COVID stimulus and things like that, American consumers have actually saved a lot of money, but they've been spending that down, and the excess saving level is coming down. So going forward, now that student loan repayments have restarted, the economy is a little bit slower. There have been big layoffs in the financial and the tech industry. We expect that the excess savings amount is running lower, so the spending impulse is going to slow down as well. This will be particularly impactful for the middle to lower class Americans who have less room anyways. Luckily, the middle to upper class Americans have accumulated a lot of wealth in stocks and in their homes. Specifically, now that the stock holding percentage of the average American family is at all-time highs, there's a buffer. If you really get into financial trouble, you could sell something and pay for it. So this is a positive for consumer spending. Net, however, it seems fairly clear that the trend is downwards toward aggregate consumer spending in the last quarter or so. We're tracking credit card spending and defaults and things like that. It feels tighter, and I think that is an accurate assessment of how the economy is feeling in Q4 2023. Another component of how much we feel like spending is how much debt or how much access to debt we have. Our debt levels in the US for the average consumer has just gone up and up and up, and this is not a healthy sign. At some point, we'll stop borrowing money to spend, and we have to try to figure out how to pay some of that back or primarily reduce our spending. Credit card defaults are starting to rise. The regional US banks are still under pressure, and they're taking away credit for businesses to grow and expand and cover expenses. So the credit contraction is a very big indicator of how the economy would likely slow down. And outside of the automakers and the semiconductor guys, the impulse for corporations to spend, invest, build new factories, et cetera, that impulse is weak and declining. We've also seen a sharp rise in bankruptcy filings. I think we've seen some of the big ones out there, but don't forget the small and medium-sized businesses, restaurants that are closing. That is really becoming a challenge for most of the real Main Street America. This is the Chapter 11 bankruptcies. This is a little bit different. They're for the bigger companies. They're allowed to try to restructure their problems. The Chapter 7 filings, I don't have a chart for that, but the Chapter 7 filings are where they can't restructure, nobody agrees on it, and they're forced to break apart their company and sell their assets. If that starts to rise significantly, that is likely to cause a lot of problems for the economy. Meanwhile, as I mentioned, the US is actually the largest producer of energy in the world. And with the Ukraine war still ongoing and Russian oil sanctions are in place, the US has taken up the slack and has been exporting and producing more energy, specifically to Europe. That has grown rapidly. Unfortunately for Europe, it's unlikely that they are going to stop importing more. I think they have a security need and they need to diversify their suppliers. But with Russia offline and Russia being one of the closest, cheapest, easiest sources of energy, they really need to scramble to figure out how to manage this. It's likely that Europe will be under this energy pressure. They're going to just end up paying more for energy globally than anybody else. That's a real negative for the European economy. I'd like to highlight here too, also a black swan thing that could happen. This is why I gave myself an out and said there could be a hard landing in 2024. Primarily, it's commercial real estate. In the United States, all these big fancy office buildings. Well, we had COVID, everybody worked from home, and now everybody's having trouble getting employees back into the office. That work from home trend has been real and significant. Many companies have cut their real estate, their office spaces to accommodate for that. And that has given a lot of pressure to that whole sector. So commercial real estate, specifically office real estate, is under pressure. And so far, they're getting away with it. Nobody has taken a big loss and caused a systemic problem. However, that's big money. It's really linked to a lot of big financial institutions as well as US regional banks. And if something were to go wrong, if there was a fire sale somebody couldn't manage and a big institution got caught, it could have systemic impact to the financial sector that we haven't planned for. Specifically, a lot of that money was in the private credit, the private equity circles. Those are not public markets. Those are private markets. They're opaque. They're not easy to track. So that's a real area, potential area where something could just pop up and nobody would be ready for it, really. One other sector of credit risk could be emerging market debt. A lot of the emerging market countries that do a lot of exports, produce a lot of commodities, they'll be fine. But there are many countries that are not export oriented, they're import oriented. Their debt is in dire straits. We're thinking a lot of small African nations, small Southeast Asian nations, they could all continue to have financial problems. Just a couple of quick charts to highlight what I was talking about. Delinquent commercial real estate loans, that has been rising. And we're seeing A quality office real estate being sold at 50% off. This is not just in the West Coast, but also on the East Coast. And let's not forget, US regional banks are the highest majority owner of commercial real estate debt. They're the ones that have financed most of the local real estate projects. They are under duress because of that. Also, remember, we had the Silicon Valley Bank and all those guys had those issues. If you remember my past discussions here, a lot of that is also that they just had poorly mismatched. They didn't expect interest rates to go up so high so quickly, and they just had the wrong things in their portfolios. Specifically, they had a lot of longer term US Treasury bonds that were paying, 1 or 2%, and now they're paying 5%. They're underwater on a lot of that. If they were forced to liquidate that in order to generate cash to pay for things, they could get themselves into real trouble. So you see these bar charts going down, down, down. It hasn't actually gotten better since the Silicon Valley Bank crisis. So we need to watch for this. I would expect that it could blow up, but then also that the Fed would step in to try to help if something did blow up. But still, it's not a pleasant thing to have happen. So given my call for stagflation and the possible black swan events, my thinking, investment ideas run towards sectors that we think will still continue to spend and grow. They have the tailwind from fiscal policy or a tech trend. So I'm looking at defense, the growth tech sectors, infrastructure, semiconductors. I think sectors that will elevate on the next stage of AI development. I think those guys could do quite well. I'm looking specifically at the biotech sector and those B2B corporate AI cloud service type of firms. I think they're going to continue to do well. And I would consider that financials in general, the banks, the regional banks, possibly some of the insurers, unknown risk, I would kind of avoid those. For my crystal ball number 2, I believe that inflation is going to rebound over the next year or two. Again, sticking with my belief that we're not going to go into a real full-blown recession. There was a lot of expected recession impacts last year, therefore demand outlooks were pretty tight. I believe that demand will be okay and maybe even recover a little bit. So those expectations probably will alter how we think about inflation, as higher demand will probably drive prices up, assuming that the production or the inventory is low. That is the second point there. I have that tight supply and production of critical raw materials. That's pretty standard. I've been talking about that for a while. That hasn't really changed much. We do have continued government fiscal spending support. We have the legacy Biden policies, but now also as China had massive economic troubles this year, you're already seeing that they're trying to do things to stimulate their economy, whether that is monetary or fiscal policy, fiscal stimulus. It's coming, it'll come in 2023. Um, Finally, there are random geopolitical factors that are still out there, although overall the tensions seem to be coming down. We have bottlenecks. I don't know if you actually know, but the Panama Canal has just been going at a snail's pace. They had a massive drought, and therefore the canals didn't really work that well. Then recently, with the Israeli-Hamas war, we're seeing, Iranian-supported Yemeni rebels attacking ships in the Red Sea area. Well, now all the shippers are freaked out. They don't want to sail through there. They don't want to sail through the Suez Canal. And that is causing everybody to reroute everything all the way around Africa in order to ship things, transport things between Asia and Europe. So those are all things that cause costs and inflation to go up. Getting back to the inflation question, core PCE is actually the main indicator, main inflation tracker that the Fed uses to dictate or manage their policy. But remember, core PCE doesn't take into account the energy costs, the agriculture costs. They take those out because they say it's noisy. Yes, the core PCE has come down to within the range of what the Fed likes, giving them a little bit more flexibility with their monetary policy. However, the real headline inflation, the inflation that you and I actually pay for food, for gas, for living expenses, for going to visit the doctor, that hasn't come down as rapidly. It's still elevated. It's still in the upper 3% range. And will it come down significantly? I have a sense that it won't. Underlying any economy in the world, you need things to move and things to be used. You need electricity, power in order to drive it. Here's a really great chart of what people thought energy demand, gasoline demand, and specifically globally would be, the blue line, with EV vehicles and all that kind of stuff and a slowdown in demand. What actually happened is the black line, where it was far above forecast. The demand for gasoline globally was much higher than anyone expected. And most forecasters that I follow expect it to continue to go at least sideways, if not up. Let's not forget that the developed markets, the developed economies in the world, yes, we are more able to make that transition to electric vehicles. But for the emerging markets, it's still cheaper and faster and more convenient to have a gas-powered vehicle to ship or truck or just get around. So I think energy demand around the world is significantly higher than most expectations. Meanwhile, I've shown this chart before in similar fashions. It's a little bit more updated, but there's just not much inventory of energy out there. The little yellow arrow is showing what 2023 is. It's far below previous years. The energy producers are not really that incentivized to go and dig for more energy, for more oil, for natural gas. And we have these sanctions in place. Russia is, sneaking around trying to get their oil sold. It's a very, very messy market. But with the bigger transition towards electrification, most energy producers are just not that interested in digging for more things. I suspect the inventory levels will remain fairly low for the next decade at least. And if we get a sudden surge in demand, as I think might happen with, especially with emerging market demand, we could have a serious imbalance there. That imbalance would necessarily cause oil prices to go up. And here's Goldman Sachs's outlook for 2024. I think what is interesting is on the right is cash. That makes sense. Money market funds are paying us roughly 5% because the Fed fund rate's around 5%. As we go towards the left, they think actually that stocks might do okay, go 10, 12% annually gain, but they are more bullish actually on commodities, which would kind of backstop and verify what I'm talking about, where I think demand might be a little bit higher, but supply is still quite tight. And quickly here, this is a little bit out of place, but I wanted to highlight the fact that right now there's high expectations that the Fed will cut interest rates in 2024. Now, what that actually means, though, is if we have a recession, the Fed will cut and stimulate the economy. If we still have sticky inflation, the Fed is not inclined to cut interest rates, okay? Because they don't want to overstimulate and overheat the economy either. So what is it's a little bit of the market is excited that the Fed might cut next year. They've even forecasted they'll make 6 cuts instead of 3, as the Fed itself said they would do. But also remember, if they actually do cut rates, it means probably we're in recession. And what actually happens in the stock market is once the Fed does cut rates, the stock market tends to go down for a period. So if inflation does rebound in 2024, if inflation remains relatively sticky, I think the investment directions will be, again, towards natural resources, commodities, the mining industry. We would consider the industries that do well in high interest rate environments, such as the money market funds or income producing funds. But the ones that are very sensitive to interest rates, high interest rates, like real estate and construction, they might not do as well. My third crystal ball is I believe net global liquidity will be rising. And historically, over the last decade or so, with the advent, well, I shouldn't say advent, but with the full-blown effect of QE globally, we've seen that with liquidity, risk assets tend to go up. And I think that's what we're looking for. So I'll show you what I see is the liquidity tracker. I believe the EU is actually going to be facing recession in 2024. Japan, China, US are in a slowdown mode. Maybe they start to recover a little bit, but definitely it's not robust. Those are type of environments where central banks tend to want to hit the gas a little bit and do some stimulus. And their primary way of doing that is using monetary policies that boost liquidity. Here's a global heat map of central bank liquidity. Green is being more stimulative, producing or providing more liquidity. Red is obviously the opposite of that. So this should go in a cycle where we're at the red parts, it's shifting to yellow. The next stop is not likely to be red again, it's likely to be green, a more stimulative, more higher liquidity environment in order to get the economies running again. And when we map global liquidity against financial assets, the growth of liquidity against the growth of financial asset prices, we see a fairly tight correlation whereby as liquidity grows, so do the financial assets, stocks and bonds. They tend to do pretty well when when the liquidity is provided by the government. More specifically, when we look at the S&P 500 versus global liquidity, we see again a fairly tight correlation between how much liquidity is available versus how the stock market does. This tends to explain much better than all past economic theories of why the last 10 years We've had very low inflation, very low economic growth, yet the stock markets have just been booming. The bond markets have been booming. Remember, stocks and bonds used to be inversely correlated. When stocks went up, bonds didn't do so well, and when bonds went up, stocks didn't do so well. Since we've been employing QE globally, stocks and bonds tend to move together, which is a very unique and not intuitive thing. I think we're heading towards that type of environment again. In this recent chart, I just wanted to highlight again, the gold line is what the Fed, their dot plot, their expectations going forward. They're thinking maybe in 2024 to have maybe three Fed fund rate cuts. Whereas the market, the bond market specifically, they think it'll be up to six. I think this is a big mismatch in expectations that will reflect in the stock markets next year. If the Fed doesn't cut or doesn't cut as much, we've already priced in some of the goodness from a rate cut. I think it could have a negative impact on the markets if the rate cuts were delayed or fewer than market expectations. And this chart is a great one to reiterate that once the Fed actually does cut rates, stocks don't tend to do that well because cutting rates means there's a recession, means there's economic negative growth, and it's not good for earnings and growth and all those type of expectations. So it tends to be a negative. It's bad news for the stock market. So again, I think net global liquidity is going to start to rise again for the world. The economies have all slowed down. The next stage in central bank and government thinking is to re-stimulate. So the longer term trend should be towards more liquidity. I also want to highlight the difference. Cutting rates does not necessarily provide liquidity. However, issuing more sovereign debt does tend to increase liquidity. So U.S. Treasury issuance is actually a major factor in how much liquidity is in the system and what will end up showing up in the financial markets. Generally, as liquidity rises, I believe most risk assets will tend to do well. I've highlighted, I think stocks and bonds will do better than real estate. I think emerging markets will do better than developed markets. I think high growth sectors will do better than just value sectors. And I also believe that crypto and gold might do quite well. My fourth crystal ball is I get the sense that geopolitical tensions are cooling a little bit. I think they were at a hard boil in 2023, but they're going towards more of a simmering situation. Specifically, let's look at the Ukraine. Basically, it's a stalemate. Neither side is powerful enough to decisively win. With the political tensions also domestically in the U.S., funding for the Ukraine that is looking less and less robust. So I think that the Ukraine and Russia may end up having to drag it out longer and just kind of, war of attrition type of war, or they may finally also just sit down and talk about ceasefires and a peace agreement. For 2024, I think that is in place. Similarly, the U.S. and China, the tensions were ratcheting up day by day all year over the last few years. However, in China, the economy really, really took a hit. Their property sector basically imploded. And with a wealth of the average Chinese citizen tied into private residences like that, they're feeling a lot of pain. And as the sanctions and all those things start to take root, China's economy is just under the weather, and Xi Jinping finally decided across the board to start to ratchet down tensions. And you saw he made a big trip to San Francisco in September to meet with President Biden. Those type of things will probably carry on at least for the next year as China tries to right its economy and provide the prosperity that keeps him in power. I do think that under the surface, there is just going to be a massive propaganda wars using AI with elections in place. That is the favorite war ground battle area that I think the non-friendlies of towards the U.S. will want to play in. So top level tensions seem to be cooling a little bit. Finally, we have the Israeli-Hamas war. This is a very new event. As I had mentioned earlier, I think this is a very messy, very complicated, long-going kind of war. Having said that, there are definitely strong motives for the U.S., for the Saudis to not let it expand and get out of control. With elections coming up and a divided America again on whether to support Israel or the Palestinians, this is not a popular political topic. And I think the U.S. is going to do its very, very best to try to not let that escalate. Having said that, Iran is very much happy with how things are going. They love to see the confusion, distraction that the Americans and their allies are facing. So it could go either way. It's a highly uncertain environment. I would just weigh that the U.S. Decision and response will be much more tame than people expect. Here's just a quick, simple little picture of Janet Yellen talking to President Xi Jinping when he was visiting. It's interesting that high-level military and trade talks, they've all been bogged down between U.S. and China. But talking with the U.S. Treasury Secretary has always been relatively easy. It really highlights the fact that China is feeling a lot of economic pressures. They want to make that better. So I think 2024 will be, they'll try their hardest not to be annoyed too much by the U.S. sanctions and try to promote more positive dialogue. Meanwhile, in the Middle East, Israel is fighting a war on almost six fronts, with Iran being the puppet master in the back that provides intelligence, weapons, strategies. Iran is very, very happy to just play these wars in proxy states. However, as I mentioned, the U.S. is not eager to expand the conflict. Neither are the Saudis. They want things to keep going. They want the trade and commerce to continue. What is a real unknown is how Israel will decide to tone it back or not. Obviously, the U.S. can apply some pressure, but at the end of the day, Israel is its independent state. They are very, very capable. And if they decide to escalate or do preventive measures directly towards Iran, things in the Middle East could possibly get out of control. This leads to my second black swan. Basically, my point is accidents happen. When you have warriors and combatants in close proximity and emotions are running high, things can just happen. And when you're committed and you have alliances to protect and defend Israel, you could be dragged into a bigger escalation, even though you don't want it. As I mentioned, terrorists and rebels are attacking ships in the Red Sea, essentially canceling all the commerce and traffic that goes from the Suez Canal to Europe. This is causing increasing pressures and strife for the global economies. Similarly, in the South China Seas, where Taiwan and the Philippines are day to day constantly dealing with more aggressive Chinese naval and Air Force elements, accidents happen. And this is the danger where the U.S. is committed with its allies to support Taiwan and the Philippines. If pushing gets to shoving and things escalate, that would be an unfortunate black swan event. Just a quick picture to highlight the geography in the area. It's all very, very close together. To reiterate, China believes that all the blue area or the yellow line area is theirs, and the international maritime laws say, no, that's junk. We don't need to follow that. That's just what you said, not what we said. So there's just constant conflict and potential for problems. And China has been using their Navy and Coast Guard with water cannons and blasting little ships, little Philippine fishermen, etc., etc. It's just a very, very tense situation. It's really ratcheting up patriotic emotions in the Philippines. This has also led, or perhaps even spurred by the new Philippine president being more pro-U.S., signing big agreements with the United States to build four new military bases in the Philippines that would really, really hamper China's ability to control the South China Seas. My fifth crystal ball is I do believe the US dollar, which has been strong, strong, strong for the last few years, is finally on the other cycle. So I think it's in a structural, secular bearish cycle for the next year or two. The developed countries, the advanced nations, they're all slowing down for economic reasons, for demographic reasons, for war reasons. It's going to be slow, even recessionary type of thing. So with less trade and economic activity, there's just less global trade and therefore less demand for US dollars. So I think that there's some reduction in demand there. Meanwhile, within the EM countries, specifically Southeast Asia and with Latin America, China has been working very, very hard to set up direct swap agreements with their main trading partners. And now within the emerging market world, there are more and more transactions that are done not in US dollars. And that trend will probably continue and grow over the years if nothing changes. Finally, the US, to pay for all our deficits, pay for war spending, et cetera, we've been issuing and intend to issue a lot of US treasuries. So once we sell those US treasury bonds and bills and notes, we expect people to pay for it in US dollars. So for sure, there's going to be domestic demand from our own banks, but international demand, foreign central banks, they tend to, when they get dollars, recycle it and buy US treasuries. Well, if they have less US dollars because trade volumes are down, they just didn't have as many US dollars, there's less demand for US treasuries as well. That will probably drive yields to be very bumpy and also perhaps reduce the appeal of having US dollars. So all of these factors I think will contribute to the dollar finally going on a secular bear cycle. Now, I know in 2023 there was a lot of buzz about big deglobalization, de-dollarization trend. China has got all their buddies together with the BRIC nations, and they're going to compete against and not use the US dollar for trade. There's a lot of mainstream media talking about the collapse of the dollar's reserve currency status, et cetera, et cetera. Just wanted to highlight here that that's really not the case. Within the world, global trade, at least on the SWIFT system, which is the primary, still the most widely used international transaction system, the dollar's usage actually went up in the last year. What got hurt was primarily the euro, less people buying and transacting in euros. So this is the actual situation. Of course, outside of the SWIFT system, the Chinese renminbi has been gaining a lot of traction. So there's no doubt that there is still that tension, but it's not as dire as people think it is. It's not as urgent as people think it is. So just wanted to drop that little note for you to consider. And I want to highlight also that it's normal for the dollar to go in cycles of strength and weakness. It's not necessarily a reflection of anything terrible about the future of the United States. It just does this. And what's more interesting is the stock markets tend to also have a little bit of an inverse correlation with the strength of the dollar. As the dollar weakens, the stock market tends to do okay. And so it's not a one-to-one, it happens exactly at the same time type of thing. But when the dollar weakens, it means US exports are actually a little bit cheaper and it makes it more attractive for foreign buyers. So they all go in a cyclical thing and it just takes a little bit of time. It's not necessarily a negative. I really like this chart as well. When we talk about the dollar index, it's the way it's constructed is very important. So it's primarily against the euro and the yen and the big currencies. But what gets left out are the smaller currencies from some of the other emerging countries like Brazil or places like that. The US dollar has actually been weakening against a lot of these Latin American currencies. And this is very interesting as those countries do a lot of commodity production and they export a lot and they've actually been doing quite well. And that also informs my feeling that emerging markets could continue to do quite well in 2024. And this chart is a little bit longer term, which is why I like it. Again, watching the dollar index, the dark line, it goes in cycles. It's not a big deal. It's not the end of the world if it gets weak or if it gets strong. It just, we have to know where we are in the cycle, know where the next phase of that cycle tends to be, and invest accordingly. This one is a very interesting chart in the sense that the blue line has something to do with the manufacturing cycle. So as the dollar weakens, US manufacturing actually starts to pick up. So that again makes sense. As the dollar weakens, US goods become cheaper for foreign buyers, and then we start to sell more of it. So that is a longer term positive. And finally, I'd like to just highlight briefly also that a lot of the emerging market stock markets have been doing really well. Again, Latin America, here is a chart on India. I mean, when you're growing, you have a young population, you're creating a lot of economic activity, even exports, you get rewarded for it. And a lot of times we're so US focused, we missed a lot of these trends and missed the opportunities. I think 2024, if the dollar does weaken, we can consider these markets more aggressively. So to restate the obvious, as the dollar is in a weakening cycle, assuming it's in a weakening cycle, we tend to see commodities and emerging markets do better. And I think we should definitely invest accordingly. Now, I don't tend to talk about cryptos and Bitcoins much, but this is now my sixth crystal ball. I think Bitcoin is now getting out of the dumps and is starting to, again, go on a secular bullish cycle. So what we saw in 2023, we saw the biggest collapse in the US I forgot the name of the guy. SBF, the guy with the big curly fro. We saw a lot of regulations, a lot of negative government pressures, so cryptos really didn't do well. That is starting to change as the dust is settling, people are picking up the pieces, and we're seeing some new regulations emerge that could really change the outcome of how, especially the big financial institutions and high net wealth families view crypto as an asset. The first is the SEC has been blocking ETFs that would work off the spot price of Bitcoin. Well, that looks like they've lost that battle. They've lost those challenges in court, and they're essentially being forced to open that up. And it looks like that may even happen as soon as January 10. So let's stay tuned for that. If that were to happen, it means a lot of our biggest financial institutions are going to launch Bitcoin ETF products. Another very wonky regulation that was in place was the accounting rules. And the accounting body has changed their outlook on how you account for it in the books for Bitcoin. That could also have a very big effect on how credible and actually reliable this Bitcoin as an asset would be viewed by investors. And then I'll show you a couple of charts to show you some of the trends that are going forward. This is a very recent Reuters article talking about BlackRock and VanEck, both they've already applied to have Bitcoin ETFs, and they're just waiting for approval from the SEC. Looks like the timing will be around January 10, and then maybe even as early as Tuesday, Wednesday, where they give preliminary announcements and direction. The crypto world, the Bitcoin world is quite excited about this transition. It's the government officially anointing this as a credible asset that will be highly regulated. but is allowed. And that's a very big, important change in regulation. And as I mentioned, the accounting world, the FASB, they have changed their rules on how to account for Bitcoin and cryptos within your balance sheet. In the past, it was a very strange situation where you could only put it in your books at the lowest price, and even if it went up or down, you couldn't modify your assets. Well, now that has changed, and that will make it a lot more easy and interesting for corporations even to actually hold Bitcoin and other cryptos in their balance asset part of their balance sheets. This is a fun chart that I like to look at. The basis of this chart was trying to follow the track and the rate of adoption of the internet and laying on the Bitcoin price to those adoption rates. So here's the thing. They call it Metcalfe's law. If something is getting network effect and more people are using it, it gains its own momentum, and then there's credibility to that. Smartphones, the internet, they all kind of were adopted at a certain rate, a certain curve. It kind of goes up and around. And what I think a lot of people needed to make sure was that Bitcoins and cryptos continued to follow that adoption curve. If you fell off that adoption curve, of course, in the future, maybe a lot of these virtual currencies would be worthless. But as it looks, the adoption curve, Bitcoin is following right along. More people are actually adopting it, using it, and that is a great foundation for the reason why Bitcoin prices could continue to go up. So this chart was trying to tell us that it's staying within the range of the internet adoption rates. And if it did, it could be in these possible price ranges. So some people estimate that by 2025, Bitcoins could be up to $100,000 a Bitcoin. And remember, we went all the way down to around 15,000 a year ago. So it is a highly volatile asset, but it makes it interesting in the sense that if this continues with historical trends and charts, getting in at current prices, even around 40,000, if it can go up 60,000, that ain't bad. This is a similar chart, but instead of tracking internet adoption rates, they're actually literally tracking the number of addresses, account owners of Bitcoin. And again, it's still following the proper curve. And so we're still within range of where we're thinking for potential Bitcoin upside. Finally, this is a very nice chart overlaying liquidity with Bitcoin and gold together. So these are kind of like gold and digital gold being Bitcoin. They tend to do well and move up when there is more liquidity in the system. And as my prior contention that I think global liquidity is rising, we have another possible tailwind to see cryptos do well in 2024. So net, I think that having a little bit of Bitcoin in a diversified portfolio makes sense. So, pick your poison. You can buy your own Bitcoins or buy an ETF if they get approved in January. To have a small portion of your assets within something that could move 100%, 200% in a year. So really quickly, Bitcoin did go up 150% in 2023, this last year. And if it continues on that kind of movement in 2024, it makes it interesting to have as an investment. My crystal ball number 7 is the one I have the least confidence in. However, we all do tend to notice that this year has been an El Nino climate year, and it has caused anomalies across the globe. It is possible and likely that the U.S. will experience some kind of drought in the next harvest season, this coming 2024. There have even been some people who believe this is going to be the next Dust Bowl from way back in the 1930s or something like that. It could be that bad. It has to do with the sun cycles, sunspot cycles, et cetera, et cetera. I'm not knowledgeable enough to really make sense of that. But overall, this year has been playing out, especially in the US, to be fairly dry and fairly warm. El Nino doesn't just affect the US, it affects the world. And so different areas of the world will tend to have reactions to that, to this climate pattern. This article from Reuters was a nice summary, and I thought that we're seeing some effects in Asia already, but possibly Latin America, South America may do better. This is very difficult as an investment to know how things actually balance and how things actually turn out. But I wanted to highlight the fact that this is not on the radar of many investors as it is so uncertain. However, El Nino cycles are fairly, there's a reason we can say generally El Ninos do this and La Ninas do that. So this is something to consider, that there could be stress in the food supply system. There could be either droughts or flooding that disrupt production and inventories. And that with other factors going on in the world, this could be another element of why inflation may continue to rise. And if we were intending to invest in this direction, there are a couple of basically 3 or 4 major agriculture conglomerate stocks out there, but you could also consider fertilizer stocks, or even countries that are just big producers of agriculture or fertilizers. And for my 8th and final crystal ball, there are a lot of elections in 2024 that are quite important and relevant. The most important being the United States presidential election. This coming election seems like it will be a real nail biter. There's going to be high uncertainty. I think there are going to be really strong independent candidates that will just change the math and the strategy across the board. And I think this is going to make it a little bit more challenging for the US markets, actually. So real quick, Taiwan is having their presidential elections in January. Russia has their election. India has their election. Those look like the incumbents, meaning Putin and Modi will probably continue to stay in power. The US election, I think what's happening is neither party is really resonating with their core. And I think that generally, Americans are looking for a younger leader, younger president for the next 4 years. And I think that opens up different channels and makes some of the independent candidates, as if they get stronger, it makes them viable options to vote for. According to Bloomberg, current polls put Biden and Trump in a dead heat. However, Robert Kennedy Jr. has stealthily, quietly been growing support and interest and funding. Meanwhile, on the Republican side, Nikki Haley looks like she's going to become the #2 most attractive candidate in the Republican Party. What if she decided that she couldn't win the primaries and decided to just go out and be an independent Republican? There has been a lot of buzz from not only the billionaire class who are starting to fund her, but even in the grassroots level, I've been hearing even Democrats saying, "Hey, we need to support her to at least get a more credible Republican candidate out there for us to vote with." So this is going to be, I think, a real nail biter. It's going to go all the way into elections, that there's just not going to be much clarity. There's going to be a lot of economic, geopolitical things that are going to pop up in between that could change the whole field and the popular sentiment. But again, I'm sticking with the belief that most Americans don't want either Biden or Trump. And if there was somebody credible that was younger, they'd be willing to try that out. So let's see how that turns out. Now, historically, stock markets in the presidential cycles, the last year, the election year, tends to be not bad for stocks. It is a factor of fiscal policies and the government trying to make sure that the economy is not in recession. The last time we had I think, a recession election time was George Bush Sr., and he lost. So definitely the Biden administration is going to do everything they can to try to make the economy feel a lot better next year. And by doing so, stocks tend to feel okay as well. If this year is as this coming election is as I fear, I don't think the stock market is going to just rip up. I think the economy is going to be sluggish. I think there's going to be a lot of uncertainty. And I think the US stock market may just kind of go sideways for a bit. So going back to the earlier slide, with consumers kind of not in a spendy mode, they're doing okay, but not in a great place. And corporations, except for a few that are in positive growth sectors, if I was a CEO of any company and I didn't know who the heck was going to win this election, I wouldn't know what policies might be ahead. And therefore, I probably wouldn't make any major decisions or investments in 2024. So I think that would possibly hamper sentiment and growth prospects for the stock market. That leads me again to consider emerging markets as maybe more attractive than the developed markets. I think the legacy stimulus programs in defense and semiconductors, electrification, reshoring, American industry, those still have money running, and those policies probably won't, even if, let's say, Trump were elected, those policies wouldn't get stopped or chopped off. Those are still good for America. I would consider that consumer discretionary, travel and leisure, those type of things probably would take a step back while we try to figure out the future direction of the United States. Okay, so that's it for me. Just to sum up, my 8 crystal balls listed for your thinking pleasure. And if I were to give a Cliff Notes versions of the investment theme ideas that I have, I do believe that 2024 will be actually not a bad year for stocks and bonds. I think they will do better than real estate. I think that emerging markets have a chance to shine over the developed markets, including the US. I do think that US growth sectors, specifically the tech sector, it's probably still their balance sheet is solid. They're a bottleneck, special technology that other people can't copy quickly. I think that will still be very appealing over, say, US value stocks. Commodities look like, assuming no major recession, demand will be robust, but supply is limited. So I still like commodities. And even though geopolitical tensions probably simmer down a little bit in 2024, it does not replace that fear and the national security drive that every country is feeling now. I do believe defense sectors will still continue to be robust. And finally, I like the idea of the next stage of where AI is going to take the world. 2023 was amazing for AI, for all the chat things, the AI generated artwork and music, et cetera, et cetera. Those are great experiments. Now we need to try to figure out how to monetize them. And so I think 2024 will be a focus on using AI, especially in the corporate world, to enhance productivity, cut costs. Also, specifically within the biotech research space, they can get to the next level of speed and robustness and come up with amazing new drugs that could change longevity and our health. I think those are up and coming and kind of exciting, and it would be great to probably have a little investment in some sectors there. To repeat the black swans, just military accidents. There's so much going on around the world, and hopefully no bad accidents happen that draw the big boys to puff up their chest and go at it. And finally, a credit event, specifically starting with the US commercial real estate office sector, that could have potential repercussions that are unknowable at this stage. You can't see it, you can't track it because it's in the private markets, but could spill over, kind of like in 2008. I would say the black swans are low probability in my mind, but accidents are accidents and they're by their nature unpredictable. So keep your eyes open for that. Happy trading, happy investing, and happy new year. And as usual, I'm open to comments and questions. Feel free to reach out to me if you have any thoughts or questions, and please share with your friends and family if this might be of use to their financial well-being. All right, take care, folks. Happy New Year.